Welcome to Section 2 of the Inventory and Cost Accounting Cycle. This is where inventory actually enters your business, and where its cost basis is set for the rest of its life. Over the next few minutes, you will see how a purchase need becomes an approved order, how goods are inspected and accepted, and how every legitimate cost of getting that inventory in the door rolls into a single landed cost. Get this phase right, and everything downstream is built on solid ground. By the end of this section, you will be able to do 5 things. First, explain what triggers a replenishment and how a purchase requisition documents the need. Second, apply Incoterms to work out which costs the buyer actually bears. Third, identify the 3 checks performed when goods arrive, before anything reaches usable stock. Fourth, define which import duties and freight charges belong in inventory cost. And fifth, record that inventory correctly at landed cost, the cost basis required under the standards. Let's start where every purchase begins, with the need itself. Every purchase starts with a quantified need. Here's the key thing. Inventory should be replenished by design, not by panic. A replenishment is triggered when the reorder point is reached, when the production plan creates bill of materials-driven demand, when safety stock is depleted, or when a seasonal forecast signals it. That need becomes a purchase requisition, or PR, which documents the item, quantity, required date, estimated cost, and business justification. Crucially, every requisition must be approved before a purchase order is raised. For manufacturers, the planning system calculates the reorder point from average daily demand times lead time, plus safety stock. Those parameters are reviewed quarterly so they reflect reality. Once the need is authorized, you choose who fills it. With the need approved, procurement selects a supplier, either from an approved vendor list or through competitive quotes. The purchase order, or PO, is the legal contract, and it must specify the supplier, item, quantity, agreed unit price, currency, payment terms, Incoterms, and required delivery date. Approval thresholds apply by spend level, so larger commitments get more scrutiny. Here's a control most people overlook. Before finalizing the PO, the agreed price should be compared to the current standard material cost in the cost system. A significant gap should trigger a standard cost review rather than being quietly absorbed. And the firm rule: no goods should be received without an approved PO already in the system. One term on that order deserves its own slide, because it quietly determines your costs. Incoterms decide where ownership transfers and which landed cost components the buyer carries, so they are critical to costing. Consider 2 extremes. Under FOB, the buyer bears freight and insurance once the goods are loaded, so those costs land in your inventory value. Under DDP, the seller bears all costs right up to your door, so far less freight flows to you. Most people assume the invoice price tells the whole story, but the Incoterm tells you what hidden costs you are about to inherit. Read it before you sign, because it changes the math you will do at receipt. Speaking of receipt, that is where goods are checked before they ever count as stock. When goods arrive, 3 checks happen against the purchase order. First, a quantity check, units received versus units ordered, with any shortfall or excess documented. Second, a quality check, verifying the goods match the ordered specification and rejecting anything non-conforming with a rejection notice. Third, a condition check, inspecting for transit damage and photographing it before accepting or rejecting. Only accepted quantities go onto the goods receipt note, or GRN. Here's why this matters for accounting. The GRN is also the trigger to record the inventory asset at landed cost, and partial receipts are recorded at the prorated unit cost. Goods not yet inspected sit in quarantine, not in usable stock, and rejected items are not recorded until an acceptable replacement arrives. For imports, one more gate stands between the dock and the warehouse. For imported goods, customs clearance must be completed before release. That means a commercial invoice, packing list, bill of lading or airway bill, certificate of origin, and product certificates. Import duties are calculated on the customs value, in most countries the CIF value, and the HS tariff code classification determines the rate. Here's a trap. Incorrect HS classification is one of the most common audit errors, and it can pull in anti-dumping duties or surcharges for specific product and country combinations. Value-added tax or goods and services tax on import is tracked for input credit recovery, and customs records are retained 5 to 7 years. The key accounting point: all import duties are capitalizable into inventory cost. They are not expenses, and routing them through an expense account understates inventory and distorts the timing of cost of goods sold. Now we pull every cost together. Landed cost is the total cost to bring inventory to its present location and condition, and it is the correct inventory cost basis under a SC 330 and IAS 2. So what goes in? The purchase price net of trade discounts, import duties, inbound freight, insurance in transit, port and customs handling, and currency conversion costs translated at the transaction date rate. What stays out? Storage after receipt, outbound freight, abnormal transit losses, and general administrative overhead. The surprising part for many is that the same dollar of freight is capitalizable inbound, but an expense outbound. The direction matters. Getting this boundary right is the difference between an accurate balance sheet and a distorted one. Once you know the components, the calculation itself is simple. The landed cost per unit is simply total landed cost divided by units received. For manufactured raw materials, this per unit figure becomes the standard cost input, and for merchandise, it is directly the inventory value. In practice, this means the work you did classifying costs now feeds straight into valuation. Each month, a landed cost variance analysis compares the actual landed cost per unit against the standard, and the gap is investigated for supplier pricing, logistics, and duty changes. Here's the discipline. When the actual landed cost deviates significantly from standard, the standard material cost should be updated rather than left stale. That keeps your cost system honest and your variances meaningful. Let's bring the whole phase together. Let's pull the threads together. Procurement begins with an authorized need, and no goods enter without an approved purchase order behind them. Incoterms quietly decide which costs you carry, so read them before you sign. At receipt, the 3 checks protect stock quality, and the GRN records the inventory asset at landed cost. Above all, remember that import duties and inbound freight are capitalizable, never expensed, because expensing them understates inventory and distorts cost of goods sold timing. Finally, the per unit landed cost becomes your valuation and your standard cost input, monitored through monthly variance analysis. Next, we build the costing system itself. Thank you for completing this section on procurement, receipt, and landed cost.